Here's a strange fact. Most people who quit their SIP don't quit because the fund did badly. They quit because they got tired first. The fund was often fine. The investor wasn't. When an SIP, that's a systematic investment plan, investing a fixed amount at regular intervals, usually monthly, instead of all at once, doesn't show the return someone expected after a year or two, the natural conclusion is this fund isn't working, I picked wrong. So they switch funds or stop investing altogether right when things feel worst. It seems like a reasonable, even responsible reaction. You're not supposed to just sit on an underperforming investment, right? But this instinct skips a question that matters more than which fund you picked. Is this actually the fund failing? Or is this just what investing normally looks like in year 2? Let's break down what's really going on, one piece at a time. First, what do long-term equity returns actually look like? Year by year, most people, when they hear equities have historically delivered strong long-term returns, picture something close to a steady climb, a bit like a fixed deposit, just with a higher number attached. That's not how it works. Looking at illustrative long-period market data, spanning multiple decades, a small handful of years deliver outsized, bumpered returns, years where markets have moved up 30%, even 70 to 80% in exceptional years, while the majority of years deliver much more modest, single-digit returns. It's the rare standout years that pull the long-term average up to what looks like a healthy double-digit number. This is illustrative, historical data, past performance, and not a guarantee of what will happen going forward. But the pattern itself is the point. Strong long-term averages are usually built from a few great years, not many good ones. Second, why does this matter for how an SIP actually feels to the person doing it? If you start an SIP right before one of those quieter, single-digit years, or 2 or 3 of them in a row, your statement is going to look flat or barely positive for a while. Nothing has gone wrong. This is what the many ordinary years, few great years pattern looks like from the inside. But nobody experiences it as this is statistically normal. They experience it as my investment isn't growing. Third, what does patience running out actually look like in practice? It's rarely a single dramatic decision. It's usually a slow erosion, the SIP that gets paused just for this month and never restarts. Or the redemption after 18 months of flat returns because a colleague mentioned a stock that's up 40%. Or simply losing the thread of why the investment was started in the first place. This is what can be called patience decay. Staying invested for the long term is very easy to say and considerably harder to actually do once the returns go quiet for a stretch. It doesn't take a market crash to break an SIP. Boredom and doubt are usually enough. Fourth, why is quitting during the flat stretch often the worst possible timing? This connects to a related idea called mean reversion, the tendency for performance that's been unusually weak or unusually strong to move back toward its long-term average over time. A flat or slow period doesn't reliably predict what comes next. If anything, a prolonged quiet stretch has often historically preceded a stronger one, though this isn't something that can be timed or predicted in advance. The investor who exits after 2 disappointing years isn't avoiding a bad investment. They're often stepping out right before the part of the cycle that would have justified staying in. Picture 2 people who both start the same SIP on the same day. One checks their portfolio every few months, sees a flat 2 years, and stops, moving the money into a fixed deposit until things improve. The other keeps the SIP running on autopilot, barely looking at it. 10 years later, both have gone through the exact same market. But only one of them was still invested during the strong years that eventually showed up. The fund didn't treat them differently. Their own behavior did. Before deciding a fund has failed you, ask a different question. Has time failed? Or has patience run out first? A flat couple of years in an SIP is usually a feature of how markets work, not a signal to exit. That's it for this one. Thanks for watching. Check out the video description. We have packed it with resources just for you. If you found this video helpful, please give it a thumbs up and share it with someone who needs it.